Today, we're talking about the tax credits buried in the one big beautiful bill that could make a real difference for business owners. We're going to hit 4 in particular: research and development, paid family medical leave, the FICA Tip Credit, and employer childcare benefits. Don't tune out. These aren't just for giant corporations. Some of these changes could hit small and mid-sized businesses right where it matters.
Welcome back to Throttle Finance, a financial literacy podcast where we break down complex financial topics into fun, relatable, practical conversations. My name is Felicia, and I am your CEO at KB Consulting.
And I'm Allie, co-host and senior bookkeeper. Whether you're running a race program or just getting your business off the ground, we're here to help you make small shifts that drive better financial performance. Last week on the podcast, we broke down the SALT deduction, what it is, why it exists, and how the big beautiful bill is changing it. We explained the jump from the $10,000 cap to the $40,000 cap for the joint filers starting in 2025, the history behind the cap, and who this really benefits. We showed how 2 couples with the same income could have completely different tax outcomes based on solely where they live. So if you missed that episode, go back and find out if this change means big savings for you or nothing at all.
This week's episode is geared for our employers and our small business owners. Today, we're going to be talking about a lot of different discussions that surround research and development for businesses, paid family medical leave breaks that employers can take advantage of, employer FICA Tip Credits, like your Medicare and your Social Security taxes that you pay on employee wages, and we're going to discuss childcare benefits as well, too. This isn't tax trivia. It's the money that you could actually be leaving on the table. And in some cases, these credits just got permanent extensions or they got major upgrades.
All right, so let's start with the R&D. Traditionally, this is where people think like big pharma, Silicon Valley, engineers with white coats.
Yeah.
But the definition is much broader. If your business is creating or improving a product, processes, software, or even a formula, you might be in the game.
Right. Things like wages, the contractor pay, your cloud computing, even raw materials that are used in development. All of that could potentially qualify for the research and development tax credit. And the one big beautiful bill brought back the ability to immediately qualify your domestic research and development costs starting in 2025. So that's really big. It's a focus on domestic labor, domestic materials, domestic, to boost our economy here domestically. That's what this is incentivized for. Small businesses that have $31 million or less in gross receipts can even apply this credit change retroactively back to 2022. So that could be a huge cash flow lever, right? If you had R&D domestic expenses in 2022, 2023, 2024, you should have been amortizing it over a schedule so far. But what this tax break allows you to do now is it allows you to go back and qualify the rest of it immediately. So this literally could be a cash influx for your program so that you could continue to put it towards more research and more development. That is the idea, right? The foreign research and development still has to be amortized over the 15-year schedule. So if you're running testing overseas, just keep that in mind. All of that still happens over the amortization schedule. But if it's development that's happening here within the United States, it's much more favorable for our domestic employers.
So let's look at this a little deeper from a race team's perspective. Think like a team located here in the United States who will be competing in a national level race series next year, and they want to start developing next year's race machine. So the IRS definition of research and development requires the following criteria to be met. The first one is for permitted purpose, improving performance, reliability, or quality of a business component. So a race vehicle being developed to compete nationally checks that box when you are competing for contingency money or have sponsorship, marketing, revenue attached to your program. So number 2 is technological in nature. So it relies on engineering, physics, or computer science. The design and testing race teams go through certainly checks this box as well. So number 3 is elimination of uncertainty. You're trying to determine how to hit certain performance targets, like speed, handling, reliability. That's uncertainty. Number 4 is the process of experimentation. So testing at racetracks, trialing new parts, simulations, all of that is experimentation. So yes, a race team developing next year's vehicle definitely looks like a textbook example of research and development, doesn't it?
Bingo! So to kind of recap how this benefits a race team, they're going to be able to qualify their domestic costs immediately instead of amortizing, which means that wages that they pay to their United States engineers, contractors, costs that are associated with testing in the United States that are involved with improving the machine that they're building, right? Domestic parts that are purchased or manufactured, domestic supplies that are all purchased and manufactured. These could all potentially generate research and development tax credits and would apply for the immediate credit, not the amortized schedule, like all of the international costs involved would be. So that's a huge win, in my opinion. International costs are still stuck with that 15-year amortization requirement, so that doesn't go away. So if you're paying like an overseas suspension technician, or if you're buying like specialized parts from a European manufacturer, for example, those expenses still need to be amortized over time, as the law states. Think of something like an Arch Motorcycles, right? Keanu Reeves' team in Moto America, they're developing everything for the bike here in the United States on their own. Most of everything that's done in the United States should be applicable for this R&D credit. So it's really cool. Small teams that have less than 31 million in receipts, like I said, might be able to backdate those domestic costs to 2022, which again, it gives you more leverage to be able to continue your R&D efforts, which is exactly what this is stimulated to do for the economy. And so really what teams should be thinking about is a strategy call at this point. They may want to structure more development and more contract work domestically here within the United States rather than outsourcing some of this stuff overseas so that they can maximize the benefit and control a lot of the things a lot more, right? If a team is still in the early stages under 5 million, they might actually be able to apply the credit against payroll taxes as well for the R&D activity. The catch, though, is that the IRS does tend to scrutinize motorsports more heavily, I'd say, because there is the possibility of that blurred line between a business expense and a sporting activity. So the key for race teams is just to make sure that we are documenting the experimental process, things like your track testing logs, your engineering reports, your design revisions, email communications, all of those things that you'll need to support your case. You should be compiling all of that in a centralized location. You should ensure that your expenses tied directly to the R&D and that it's not just racing operations, right? If you're just going around the track just to spin laps and get familiar with a specific track, that's not necessarily R&D. But if you're going out there testing out a new swing arm and there's different modifications that you make to the swing arm over time, or there's different variations that you're going to go out there and you're going to test all simultaneously, as long as you have detailed documented processes around what happens when you do that R&D, like that should help support your case for this credit. And, it's a matter of bookkeeping discipline at this point, making sure that you separate those R&D activities from the expenses that are related to the actual competition aspect of racing your race vehicle.
I think this ties in really well with one of our previous episodes. We were talking about task management. And I think that this just makes it like a very legitimate business, and it makes it less, like you said, of a sporting activity and makes it into a legitimate research and development type business.
Yeah. And what's the main difference right there, right? It's documenting the processes. It's having that structured environment, which a lot of teams arguably already have. It's just, is that information spread amongst 3 individuals, a couple of different companies?
Yeah.
Is it digitized? Is it, a pad of paper where we're taking notes out? Like on the track, the key is that you want to compile all of it, put it in one centralized location, and you want to have it ready to go with like a nice little pretty bow to hand over to your tax professional at the end of the year and say, these are the things that I think are probably applicable for this credit.
You know what I also think is cool about it too is, looking at like your other half, you've talked about him before being a BMW technician, and he's one of the few in the United States. I think that it's going to create more jobs like that, and it's going to create more professionals in that field because they're going to be like, well, if we can't outsource it, we're going to have to start making more professionals here. Okay, let's move on to the paid family medical leave tax credit. So this was set to sunset in 2025, but the One Big Beautiful Bill is making it permanent. Employers can claim 12.5% of the wages they pay during the family and medical leave, with the tax credit scaling up to 25% if you cover a higher percentage of wages. So the credit applied for 12 weeks of leave annually per qualified employee. Qualified employers must maintain a written policy granting full-time workers at least 2 weeks of paid family medical leave, with part-time employees ineligible on a pro rata basis. But there's flexibility now. Employers can calculate the credit on wages or premiums if they're using an insurance model. Plus, state-mandated paid leave now counts towards eligibility, which makes it easier for multi-state employees to qualify.
Yep. So what this really means is that if you, as the employer, offer at least 50% of the employee's regular wages during a family or medical leave, like your own internal company policy that's part of your employee handbook, right? Where you, as the employer, are footing the bill for those wages that you're paying them while they're on leave and they're not performing work duties for you, then you can still claim a 12.5% credit on those specific wages. But now this scales. For every additional 1% over the 50% of wages that you cover, the credit increases by 0.25% up to the maximum of 25%. So if you pay 50% of their normal wages, you get a 12.5% credit. If you pay 70% of their normal wages, you get a 17.5% credit. If you pay 100% of their wages, then you get a 25% credit. So the incentive is structured to reward employers who cover more of the employee's normal pay during leave. And the alternative of this is if you're an employer that doesn't cover the employee's leave, the state does, right? There's state mandated programs. And so like the incentive, like the way this is working is it's a tax code that's incentivizing the employer to take on the responsibility of paying the employee during a leave rather than the employee relying on government processes and government budgets, essentially, to get the pay while they're on leave.
Yeah.
So traditionally, the credits only worked if the wages were paid directly to the employee, but some employers don't handle leave in that manner, right? Some of them, like they buy insurance or they pay premiums on a plan that basically provides like a wage replacement. Like let's say somebody's going to have a baby or something like that, right? They might continue to cover their insurance while they're on leave, but not pay them wages. And so now under the OB3 bill, they have the choice to either calculate the credit based on the wages that they actually pay the employee while they're on leave, or they can calculate it based on premiums that they pay for a qualifying insurance arrangement that covers the leave. So if you directly pay your employee $2,000 during their leave, you can use that $2,000 as your base. And now likewise, if you get paid $2,000 in premium for a policy that covers the employee's leave, you can use those premiums as the base, even though you didn't actually pay anything out to the employee directly, if that makes sense. So it creates more parity between different employer level structures, more flexibility. And I think the coolest part about this is that state leave now begins to count. So previously there was confusion, like let's say like for California, New York, or New Jersey, one of those states, the state requires the employers to offer paid family leave. It was a question on whether or not that disqualified you from the credit because it was no longer voluntary by the employer, right?
Yeah.
It was a state mandated policy. So the OB3 bill clears this up. State and local mandates do satisfy the federal requirements, and they will not reduce the credit amount that the employer is eligible to claim. So I think that's cool. So essentially, a California employer follows the state paid leave program can still claim the federal tax credit as long as they meet the wage percent and the policy requirements. So as long as they meet the minimum that the state mandates that they need to pay out, either through direct wages or through a policy requirement. So I think that's a pretty big deal for multi-state employers because now compliance with state law also factors in to the federal credit eligibility, right? Instead of canceling each other out. Now, if you're a multi-state payroll provider, right? Like I think of our clients, Allison, like we definitely have an employer, right? That has employees in California and New York and in New Jersey.
Yeah.
Right. So they have 3 states where it's mandated. They'll hit that credit cap faster because they have those state mandated policies in place. Whereas, some of their other states where they do payroll and like maybe Arkansas or North Dakota or something like that don't have those mandates in place. Think of a salaried employee, right? Like when we agreed upon your salary, it was like, I know what it is all the time. We have the unlimited PTO in place. For that reason, we're a small team. It works for us. But like, no matter what, like if you needed to take a leave, like I would still continue to pay because like I already had committed to that.
Yeah.
So like for me, this just kind of like reiterates like you put people on salary for a reason because you pay them for the work regardless of what they're actually working. Like that's like what salaried is, Like it's like I don't think that this is like really like a big thing. It's more like for how you spin it to be a positive for your company.
Yeah.
Like if you let the government just pay out the leave, you don't get to take any credits.
Whereas
But like
if you actually give in to your employees, now you actually get to take at least a small credit.
yeah, and it's like a nice looking thing to the employee, right? I don't have to fight with the government to get my money if I go on a medical leave because I get
can trust that
pregnant.
my employer is going to essentially help me out.
Exactly.
Get my back. Yeah.
Yeah, and it's like I stay on my same payroll schedule. I don't have to worry about filing claims with the government, waiting for it to get approved, potentially disapproved, having to fight all of that. It's like a peace of mind for your employees, and you can like you levy it through your benefit package, which is why having the handbook is so important, and that's why it's a critical component of the requirements to be able to take this credit is that you have to have a full-blown compliant policy in place that meets both the state and the federal minimums for wherever it is that you're operating your business from. And if that's a remote company in 18 different states, so that means that you have to be compliant and have a policy that fits the bill across all 18 states, So I can definitely see the perks for it, but most of the perks I see is that it allows the employer a little bit of deductibility, but more so it's like more of a leverage of benefits, like being able to just make sure that you retain those employees that are key performers in your business that really make you, make the revenue.
So for employers, you should probably start thinking about the following: reviewing current FMLA policies, looking at your own internal written policies, seeing if it covers all necessary employee types like full-time and part-time, making sure policies meet the standard of the credit in terms of the length of leave and the percent of the pay covered. And if any of these things are not in alignment, or if you're totally confused, that's your yellow flag here. And it's time to bring a professional on board to review your processes.
Exactly.
So now we're going to talk about the FICA Tip Credit. FICA, before the One Big Beautiful Bill, that was really just a restaurant thing. So employers in food and beverage could claim a credit for the FICA tax they paid on employee tips, but only for tips that went above the minimum wage. So if a server is making $2.13 an hour plus tips, their tips pushed them over the federal minimum wage, the employer got a credit for the payroll taxes that they paid on those tips. And this has been in place since nearly the early 2000s.
Exactly. It was designed to help restaurants, bars, and similar businesses where tip wages are a really big part of payroll. And that's unfortunately where it stopped, right? The beauty, the personal care, and hospitality outside of like food services were left completely out. So now the OB3 bill expands this way beyond restaurants, which I think is a really positive.
It makes you wonder if this is going to, I think about all the places that are tipped, and I think about I have tattoos, and every time you go get a tattoo, you get tipped. And it makes you wonder if they were talking about all these approved tip places. It does make you wonder if they're going to get real granular, or if they're going to keep it very broad in a sense of restaurant, bars, casinos, beauty services.
Well, I think we'll know on October 2nd, right? That's when we saw on the IRS website that they have to give the list of approved trades and
Yep.
industries for no tax on tips. So I would assume whatever industries get widened through no tax on tips would be the industries that this tip credit also expands to. Whereas like no tax on overtime, they said they were going to get granular. No tax on tips, they said they were going to get granular. So I would say whatever they define on October 2nd is probably what the standard is going to be. And we might see modifications to it over time as they evaluate fairness. But honestly, I think what's going to take it changing and expanding to other industries would be court hearings for discrimination, essentially. But like it would be like us as an accounting firm having to take this to court to say that we're being discriminated against because why shouldn't we be able to claim tips?
So now under the One Big Beautiful Bill, the scope is much broader. Starting with the tax years after December 31st, 2024, industries like barbershops, nail salons, estheticians, spas can claim this credit too. So if you have tipped employees in one of those industries, you'll soon be able to recover some of those FICA taxes the same way restaurants have for years. So just to clarify, FICA taxes are the combined 7.65% of Social Security and Medicare taxes that employers are required to pay to federal authorities for every dollar of payroll that they pay to employees.
That's correct. And one detail that I really want to bring to the surface, for restaurants, the credit calculation is still tied to the January 1st, 2007 minimum wage.
Oh my goodness.
So back to when I was a junior in high school, essentially.
Oh, really?
That frozen number is how they measure the threshold, essentially. But for these newly added industries, the calculation will be based on the current federal minimum wage. So it's not a perfect mirror, but it's still a valuable new tool. This credit is especially powerful in states like California and in Washington, where employers are required to pay the full state minimum wage for tipped employees regardless. So what that means, if you look at it like the federal minimum wage, right, in 2025 is like $7.25. But here in Washington, the state minimum wage is $16.67.
That's
and you have to
crazy.
pay them that regardless if they are a tipped employee or not. So, in states where the federal is what they go by and, that caps out at that $7.25, it's going to be less impactful for those employers.
Yeah.
But employers in like Washington, in California, in Oregon, in Nevada, in what was the other one? Like, I think Montana too, where, employers have to pay those $12 an hour plus state minimums. Like, this is a really impactful credit for them to use. And for beauty and personal care businesses in those states too, this could be a brand new, like, quote unquote revenue boost. It's not really revenue boost, right? But it's a credit that you've never been able to take advantage of before, and you totally can now, which is cool.
Very cool. I think it's cool that they finally included the beauty services in this.
I think the big one.
It's about time. It's about time.
And I think honestly, the beauty industries should be included in that list from the IRS at the release of the like approved industries on October 2nd. I would assume beauty is included in that. So if you think of like a salon owner, maybe it's a salon owner that has an S Corp election, right? And they have a couple of employees on payroll. Like, essentially, there's so many credits at play for them between their employees and the actual personal $25,000 tip deductions, and on the employer side, being able to claim an employer tip credit as well too. Like, I think that's pretty impactful.
All right. The last item on the agenda for today is the Childcare Credit. And this is for employers who offer childcare services as part of their benefit package for their employees. So the credit used to max out at $150,000 and cover 25% of expenses. The OB3 raises the stakes. Now it's up to $500,000 and covers 40% of expenses. And small businesses, those under 31 million in revenue, can get even sweeter of a deal, up to $600,000 and a 50% credit rate. Wow.
Even better, too, small businesses can pull together through third-party intermediaries to provide child care for their employees, right? So you don't have to be a giant corporation with an on-site daycare facility to qualify for this credit. So think about recruiting and the retention angle here with your employees, right? Subsidized childcare is a massive benefit for employees. And now employers have a tax incentive to make that happen.
So I have a question. So let's say I get pregnant and I have a child, and you decided you wanted to provide childcare. What would it cover, like nannies? Does it cover what would it, how would it benefit like us as a small company, I guess is my.
I don't know that it would necessarily cover a nanny. We would have to get with like probably a tax professional above our pay grade to see if that in particular would be covered. But we could partner with a local daycare facility in your area that would contract with us, basically. And if we got a contract in place that, we met certain criteria with them as far as like what I'd pay, what I'd cover, what they provide, and that kind of stuff. I think if you have the documented structure there, then especially for remote companies, like you should be able, like this is designed to boost local small businesses and that local economy. So I would think that like we would be able, like if your neighborhood daycare, let's say, right, we would be able to partner with them and get a contract in place, and we would be able to pay the childcare costs directly to them, and we would be able to cover that or reap the benefit for the credit that way. Cool. So it's like I don't have to have a childcare facility and an office to claim that necessarily, but like we could work with providers in your area or providers in my area to contract for daycare services. And like the way I see that too is like, think of downtown Seattle, right? There's Google, and Google is floors 2 through 40 of this building. But on that base layer of the plaza, there's a dog daycare, there's a regular child daycare, there's a couple of restaurants and things like that. Google might not need to have their facility on site, but they could partner with that company below on that first level to offer childcare benefits to their employees, where the child is not in the Google office and in a Google childcare facility, but it's a facility that's easy and convenient for the employee, right? Because they're still going to that same building for work. They just drop their kid off on the first floor with a different business, and they go up to the 30th floor to do their work at Google for the day.
Yeah, that's cool. That's really cool that they provide something like that.
So yeah, it just gives you that flexibility. It can either be an on-site, it could be an on-site that's contracted, or it could be like different within your community. Like maybe it's more convenient for the employee to drop the kid off at a daycare that's closer to their home. Maybe they do an hour-long commute, but it's easier for them to have that daycare closer to their home because the husband picks up the kids after work versus the wife that works later or something like that, right? So this gives you the expansion of it doesn't necessarily have to be on site. It doesn't necessarily have to be by the employer. It doesn't have to be right there in that immediate location, but it is still in the local Seattle area or in the local vicinity from where your employees are commuting from. That's how I understand this to work, is that you like have those three kind of broad options for providing and claiming the credit. But the key component is that you need to have a written policy. It's very much like the FMLA leave, where you have to have a very clear, written, defined, stringent policy in place, and that it has to be fair and it can't discriminate across employees.
So the credit is 40% of the qualified childcare facilities. Like Felicia was just saying, there's three options here. It's the amount paid to build or expand property to operate your own internal childcare facility, or operating expenses of qualified childcare facility of the taxpayer, like a facility on the ground level of a corporate building. Or the next one is contract amounts with the qualified childcare facilities to provide childcare services to employees of the taxpayer. So like agreements with the smaller facility in or around the area that might be more convenient for the employee. So it's important to know that on the provision of these services that you must not discriminate in favor of highly compensated employees.
Right. So you can't give this benefit to your top level management, but not your line supervisors or your data entry clerks or something like that. If somebody's a full-time employee, every full-time employee needs to have comparable access to these benefits, right? Which is why putting it in your handbook is part of the requirements and part of what defines the ability of being able to take this credit, is that it needs to have a written policy. It needs to be defined, it needs to be part of your company culture, it needs to be part of your company handbook. There's a lot of moving steps that you have to put in place ahead of being able to take this credit in the first place.
Yep.
I think this could be great with the constant rising cost of childcare. I think this is a wonderful addition to a benefit package that helps attract workers. And this is what we mean when you hear us preach over and over and over again about putting into your people. Yes, it is an added cost to the business, but you can take advantage of the credits. It boosts employee morale and it shows your employees that you care about building a scalable career with them and their lifestyles, their families in mind. And I think that speaks volumes from an employer standpoint. But there's, like I said, a lot of behind the scenes work that goes in tandem with implementing a benefit like this. So you should definitely make sure that you're consulting with a professional before you make any decisions related to this. But some of the questions that I would suggest that you might want to start asking yourself are as follows. Are you losing out on talent, especially your parents, to companies who are already offering childcare support as part of their benefits package? What would it cost you to replace a top employee in comparison to subsidizing childcare costs that helps keep your employees retained and keeps them involved with your business? What does it look like to partner with other small businesses in your area to pool childcare resources together? And what kind of a message ultimately do you think that it would send your team if you solved one of their biggest day-to-day stresses in their life?
Well, and especially, looking at like how much childcare, how expensive it is and how prevalent it is in homes. I mean, most your working class has children. And if you don't have to worry about it, it's a big deal.
It is.
So the Childcare Credit Expansion in the Big Beautiful Bill isn't a win across the board. If your business already invests in childcare, on-site subsidies, or even pooling resources with other small businesses, this could mean hundreds of thousands in credits back every year. But if childcare isn't on your radar yet, this change won't impact you until you decide it's part of your benefits package. Would this move the needle for your team, or do you see this as a perk only the big guys can afford? Let us know, DM us, drop a comment, or share this episode with someone weighing the same questions.
Sure that you tune in next week for our next OB3 breakdown, or rather, kind of actually something that's just not in OB3 at all, right? Something that completely had the ball dropped, Allison.
Mm-hmm.
So tune in
Tune
next
in
Friday.
next week, right?
And we'll see you then.
Bye.